Hello and welcome to Journey Towards Wealth. In today's video, let's discuss on how to plan for your kids' higher education. Every parent has a dream towards their kids. They may be looking forward for a successful career, successful life for their kids. But when it comes to higher education, many parents today are not prepared for it. Today, if you look at higher education, if an education will cost around 25 lakhs today, in another 17 to 18 years, it will cost you more than a crore. Inflation today for education is at 10 to 11%. And it is this inflation which makes it very expensive for you to actually fund your kids' higher education. But again, you do not want your kids to start up their journey called life with a huge debt to repay, like your student's loan. You would want to give them enough cushion to actually start off their life. Hence, it becomes very important for you to plan the funds needed for their higher education. Again, you have a long period from 16 to 18 years available for you to actually accumulate the fund needed for their education. All you need to do is to have a plan and meticulously plan about it, and then make the required investment, and then review the plan and follow up the plan till you reach the target that you're aiming for. I understand it's not an easy task, but if you're ready to put in that extra effort for your kids, it is a target that you can achieve. This becomes even more important if you have more than one kid and you need to fund all their education. So you need to have a proper plan in place, and you need to follow through the plan for you to actually achieve that kind of corpus for your kids' education. So when it comes to investing for your kids' higher education, the first option you have are fixed income instruments. This include your fixed deposits. It includes the corporate bonds, the PSU bonds, government securities. It has your money market instruments. It has PPF. All these are your fixed income instruments. These are instruments that give you a guaranteed return. But again, once you have a guaranteed return, that means your rate of return would be lesser. This is best suited for people who wouldn't want to take much risk. But again, once you're going for this kind of option, the investment required would be much higher than what you would be looking at for market linked instruments or real estate or such kind of investments. So if you're somebody who is very risk averse, you can look at these options. Usually the rate of return would come around probably around 5% to 7.5% in this kind of investments. Since you have a longer horizon, you have a longer time frame when it comes to accumulating wealth for your kids' higher education, it would be a not good idea to actually keep the money in these kind of investments which may not give you higher returns. The next option that you have when it comes to kids' higher education is children's mutual fund. These are mutual funds specifically intended for children, and you can have it for kids below 18 years of age. And this investment is usually done in equity market as well as in debt instruments, government bonds and other instruments. Here the allocation would be around 65 to 70% would be done towards equity for a higher returns, and also for the safety part it will be investing around 30 to 35% towards government bonds and other debt instruments. So it is a right mix for the risk reward ratio. This is suitable for people who are ready to take a bit of risk but not are aggressive risk takers. So this is an ideal combination for such people. Here the return you can expect is around 9.5% to 15% depending on the funds that you're looking at. And also this is not a guaranteed return because they invest quite a high portion towards equity funds, and you cannot have a guaranteed returns when the investments are in equity market. It is quite volatile, but over a period of 15 to 17 years, you would get a decent return if you invest in this kind of instruments. Again, these kind of mutual funds which are specific for children are available from HDFC. They are available from UTI, ICICI Prudential, Axis, and also SBI, LIC. So there are quite a few companies which are coming with these kind of specific children's mutual fund, and they are intended only for the purpose of accumulation of corpus for your children or their future. Another investment opportunity that people look at when it comes to fund their kids education is through real estate investments. But the biggest drawback for real estate investment is the kind of amount that is needed to actually start an investment in real estate. You do not get a property or a piece of land at a very low price, which you can actually think about it gearing up for a high value later on. This is something which was possible in early 2000s or 2010, but now over the current period, it gets very difficult for you to actually expect that kind of return. So, as an investment option, it is not very lucrative at this point of time. Again, you have no visibility about the kind of development that's going to happen across the country over the next couple of years. You assume the land that you have purchased or the property that you have purchased would go up in value over a period of 15 to 17 years. But you have no guarantee on that. Another thing is there are a lot of issues, legal issues which could come up when it comes to real estate investment. So these are risks which cannot be ignored when it comes to real estate investment, and also the kind of return that we were expecting in previously cannot be expected from now on in real estate investment. So it is best to avoid that kind of huge investment in real estate, especially to fund your kids' education. But another option is to go for something like REITs. The REITs or real estate investment trust is another option that is available for you to invest in real estate. This is mainly invested through the stock market or equity market, and the investments are mainly done in the commercial real estate. Here, the advantage is that it doesn't not need you to have a capital equivalent to what you will be using for a physical real estate. Here, you can invest with limited capital and wait for the money to appreciate over a period of time. But you need to understand that this is a newer investment option and it has not been around for a long period of time. So, it's a very, it is not yet a matured market, and there are laws which will keep changing over a period of time till it stabilizes. But as of today, if you look at it, you can look for a return of around 9 to 12%. This comes through, one is the dividend, which has a yield of around 5 to 6%, and then it comes through capital appreciation, which should be around 4 to 6%. So, all in all, around 9 to 12% is what you can aim for according to its past performance. But again, like equity market, there is no guarantee that this would continue. So when you're looking for a long-term horizon, especially for your kids' education, where the time frame would be around 15 to 17 years of investment, we are not sure whether this product would be able to give this kind of return over a period of time. But if you're looking for parking part of your money, this is an option that can work for you, where you have a decent return and the risk is limited because you're not actually investing huge capital into this. As of today in India, we have three REITs, which is Embassy Office Park, the second is Mindtree, and the third is Brookfields. So each of them have their own advantage and disadvantages. So you can assess it according to your individual situation and decide which works for you, or whether this as an investment class even works for you. So the next product that is available for your kids' higher education is Children's Plan, which is nothing but an insurance and investment linked product that is available from insurance companies. This product actually has insurance and investment in a single product, which is basically meant for kids' future or their higher education. This particular product is based on the emotional aspect of a parent when it comes to protection of their kids' future. The product not only offers an investment, but it also ensures that in case something happens to you, your kids' education gets covered. This is the main attraction of this product, and this is the reason why parents are able to connect well with this product and maybe that's the reason why many parents opt for this product. But again, if you look at the real investment philosophy, it is always advisable to have separate products for insurance and for your investment, because a single product for both investment and insurance may not give you the best of returns in terms of your investment. And mostly these products are in unit linked products, which is mainly investment in the equity markets. So in that case, this product would give you a return between 10 to 12% because of huge charges that are there in this kind of products. So it is actually not a great option when it comes to an investment option. But for people who has that emotional reason that insurance is also taken care with the investment, they would opt for this kind of product, and to get a decent return when it comes to the return on investment. But if you actually look at it as a product, it would be advisable if you can look at as a term insurance along with a equity linked mutual fund or index fund, which would actually fetch you much better returns than children's plan offered by insurance companies. These plans are available from almost all major companies like HDFC, ICICI Prudential, Axis, Tata, LIC. All of them offer this product. Again, you need to check whether it actually suits your need, whether you need a single product for insurance as well as investment, and then decide whether this is the best product for your kids' future. The next product that you can look at is sovereign gold bond. This is nothing but your investment in gold, and gold, as you know, is a hedge against inflation. The attraction for sovereign gold bond is it gives you an additional 2.5% annual returns along with an appreciation in the gold price. This is again a long-term investment. You need to invest at least for 8 years before you withdraw the money from this. Again, this can be part of your portfolio for your kids' higher education, but it cannot be the only item in the portfolio. So you need to allocate not more than 10% of your total portfolio in this particular asset class. Also, this will not give you astronomical returns or a great return. There is a limit to which this will be able to give you return, but it would be able to give you a decent return over a period of time. The next option available for investment for kids' higher education is index funds. Index funds are nothing but investment in the index of the Indian stock market. So if you look at Nifty 50, this is an index of the top 50 companies of the Indian stock market. And if you are investing in Nifty 50 index fund, then your allocation will follow as per the Nifty 50 index. So if you have an allocation of around 12% towards Reliance in Nifty 50, then the Nifty 50 index fund that you are investing will also have the similar allocation towards Reliance. And this will follow for all other companies that are available in the Nifty 50. Now, if you want to look for the next set of companies, which is Nifty Next 50, which is the top 51st to 100 company of the index. So this is Nifty Next 50. In that case, your allocation will be towards the 51st company to the 100th company in your index funds. So you can allocate according to your preference, whether you want to invest in the Nifty 50 or Nifty Next 50, or you're looking at a mid-cap space, then the Nifty mid-cap index. So this can be done according to your personal preference and the risk that you're ready to take on your portfolio. Again, you have mutual funds providing index funds, as well as you have ETFs which will take care of your index fund investment. This is mainly replication of the index, and hence this does not have much churning, but there is an automatic churning whenever bad companies or the companies which are not able to reach up to the expectation are removed and newer companies are added. Then there will be an automatic change in the allocation that would be given in your index funds. Again, if you're looking for a more active kind of investment where the fund manager would be taking more effort towards investment, then you can look for mutual funds that are allocated towards your large caps, towards your mid caps, towards small caps, or a multi-asset fund, or you can look at flexi cap or multi-cap funds according to your risk appetite. It is very important to understand that your allocation should be based on the risk that you are ready to take. Not everybody will have the same kind of risk, and that should be the first criteria on which you decide on what kind of allocation that you would want to make for your investment. Now, when you look at investment in index funds, the biggest advantage is the expense ratio. The expense ratio is very low when it comes to index funds. But if you're looking for actively managed funds, which is through mutual funds, then the expense ratio will be slightly higher than index funds. So you need to consider all this factor before you look at investment. So if you look at index funds, if you're looking for Nifty 50, you may expect a return of around 12%. But if you're ready to look at investing in mid cap space, then your returns would be better. It would be around 14 to 15%. Again, when you're investing in equity market, you need to understand that the returns are not linear, which means it is not like every year you would be getting 12%. It's not like that. There may be years when you will be having a down market and your returns will become negative. But this percentage that we talk about, 12%, is a CAGR, which is compounded annual growth rate, which means on an average every year, if you look at the average of it, you would be getting a return of 12%. But there is no guarantee that in a particular year you would 100% guaranteed get that return. No, it will keep changing. Some years might give you an excellent return, maybe 24%. Some year might give you negative 13% return. So it keeps going up and down, and it is not a linear kind of proposition where you can say every year you would get the same return like your fixed deposits. So this is something which you need to keep in mind when you are looking at equity investments. So the next option that you have when it comes to investing for your child's future education is to invest in Indian stocks or international stocks, whichever you are comfortable with. Again, here you need to understand that effort needed for you to select the right stock for investment is very, very important. You cannot ignore the amount of research that you need to take for you to invest in the Indian stock market, unless you are looking at companies that has been consistent performers in the past and you would just want to replicate those companies. Again, there are risks associated with it. There are market cycles that keep happening. There are changes that keep happening. But if you're a long-term investors, all you can do is to invest in some top quality large cap companies and reap the benefits of the Indian stock market. On an average, these companies will be able to provide you a return of around 15 to 20%, which again is not a linear return. It keeps fluctuating. Some years may be bad for those companies, which might fall, but eventually they will pick up, and on an average they will be able to give you a return of 15 to 20%. But again, please keep in mind this is a very risky proposition in case you are not comfortable with the volatility of the Indian stock market. The markets can be volatile during bad times, uncertain times. So you need to be aware about the risk associated with the downturns that can happen in the market. If you are aware and if you are ready to take a risk, direct equity investment is something that you can look, especially for your kids' higher education, because the time horizon is quite long. And over a period of 15 to 17 years, your market will be able to recover and give you a decent return that you are looking for. So now we have gone through all the kind of investment options that are available for your kids' higher education. Of that, some products would give you guaranteed returns, but the returns will be lower. Some plans would give you higher returns, but there is a risk associated with the volatility. Some plans would be good for your insurance and investments. So there are mixed products that are available, and you need to assess and understand your risk profile before you choose a product. But when it came to us, when we started on our journey for our daughter's higher education, first thing we did was we started early. We didn't have a visibility on what would be her area of studies, what should we be looking forward. We didn't have any idea, but we knew 18 years from the time she was born, she would go for a higher education, and we need to be prepared as parents for her higher education. So immediately after she was born, we started a mutual fund. We started SIP in a mutual fund because we knew the time horizon was long and it would give enough time for us to go through the volatilities of the market, and it would eventually the market would recover by the time she was off to her university. Since we were aware about the stock markets, we were okay with the volatility associated with it. And that was a decision which helped us to get a good returns for our investment over the past couple of years, because the markets were doing very well and the returns were great. I wouldn't say that we did the best of investment, but our returns were decent for us in terms of our investment. Because we started early, we were able to reap the benefit of investing a smaller amount to get a higher returns. In spite of a downturn in the market, we still believe that we are on track to achieve our goal by the time she is off for her university education, without much hassle or much stress on how we will fund her education. Again, what we need to understand before we decide on the investment plan for your kids' higher education is, you should first set a realistic goal. Our goal was very realistic in terms of we are looking in investing in the Indian equity market, which is volatile but which will offer us a good return over a period of time. The time horizon was long. It was around 15 to 17 years before our daughter was off to university, and that would give us enough time to recoup for any downward trends in the market. The second thing is we were sticking to our plan. We did not keep changing our plan when the market fell. Whether the market fell, market went up, whatever happened, our plan was SIP for her education in mid cap and small cap mutual fund, and it kept on happening irrespective of how the market performed. The third point is, when the market falls or when the volatility is at its peak, you can hear 100 opinions about people talking how doomed the market is, how bad your returns are going to be, how some stocks are going to be wiped off. These are all distractions when it comes to your investment. We ignored all these noises and just continued on our path for investment. And today we believe that is one reason why we are able to reap superior benefits. And the next point is, we educated ourselves on this journey. We were aware that markets had its risk. We learned further about the market. We started doing a direct investment in the stock market. But all this happened after we started educating ourselves regarding the equity market, the risk associated with it, and also the lower returns that we would get if we are invested in fixed income instruments. The biggest advantage we felt for starting early was we knew the time horizon was long, and that would be enough time for the equity market to recover and give us a decent return. Had it been a case where the time horizon is short, which is less than 3 years, we would have gone for some fixed instrument which would not be able to give us enough returns that we wanted. So if you are a parent looking for funding your higher education, the first and foremost thing you need to do is to start early, and also to understand the instrument that you are investing. Your advisor will have his own idea about investment. He would tell you about investments that would be beneficial for him. If you are not educated about the particular product, you may get carried away by his instructions and you would be ending up in wrong products. Initially, we have also gone through all this, but the good thing we did is we tried and educated ourselves. And today we can confidently say, if somebody gives us an advice, we have the questions that are required for to understand whether those are real good products, those are products that are suited for us, and they are able to give us a decent return that we are looking for. So when it comes to your kids' education, please understand you need to do whatever is best for your kid. You need to take those decisions which are in the best interest of your kid. And this can happen only when you are armored with the required knowledge that will help you to invest your money and reap the benefits of the, the growth story of this country.
This is an illustration of how the inflation works when it comes to long term goals, and also what would be the kind of investment that you need to look at if you are looking for a return of 12% per year. Now, let's see if it's a university course which would cost you around 10 lakhs today. It would cost you around 50 lakh 55,000 in another 17 years with 10% inflation. This is a huge jump to your current fees that you're seeing just because of inflation. In case you want to achieve this amount, and if you're ready to start this investment early on, you need to look for around 10,500 investment per month for 15 years for you to achieve it with a rate of return of 12% per year. Now, if you do not have the capability to start with 10,500, which is perfectly understandable, you can look for something as 6,000 per year for 15 years. The only thing is you need to step up, or you need to keep increasing this SIP every year by 10%. For example, first year you do 6,000, the next year for the next 12 months you do 6,600, and so on. This is another way to ensure that you're able to achieve your target. The same way I have illustrated for various examples or various fees that you can look at in this particular calculation. So now we have gone through the different products that are available for your kids' education, options in the market. Then there are some points that you need to keep in mind when it comes to your kids' higher education. First and foremost, you should try and withdraw the amount once you achieve the target that you're looking for, at least 3 years before the actual event of the kid going to for his university. You should give a gap of at least 3 years for you to achieve the amount, because otherwise you will have a stress in case you're not able to achieve the amount. So if you are in a position to reach the target 3 years before the time the kid goes to university, you have a stress-free time, and you will be able to enjoy that period. Many a times what happens, in our greed to get extra return, we think about one more year in the market might fetch us better return. But eventually that may not go in your interest, and the market might plunge, and you may be in a position to withdraw a lesser amount than what you have planned for. So it's important that you have this thing in mind when you're investing in the equity related products. Second thing is, we have not considered taxes in this particular calculation, and you need to consider taxes according to the product that you choose, and also according to your tax structures. Again, when it comes to equity linked products, the taxes are only long-term capital gains of 10%, that too over a withdrawal of rupees 1 lakh, which makes it more attractive compared to many other products. Another thing is, what happens is the fear. What happens if something happened to the guardian or the parent? How would the kids' education be taken care in the way that you have dreamt about? For this, you can actually include this amount in the term insurance that you're taking for your family's well-being. So, whatever the term insurance according to your income you have taken, you need to add this particular amount also. If you have one kid, amount needed for their one kid's higher education. If you have more than one kid, in the sum assured, you can actually add the amount that you're looking for all their higher education. This will ensure that you have enough money for your kids' higher education in spite of the fact something happens to you. This would give you a lot of peace of mind as a parent. Many a times people take the insurance linked children's plan or the product because of this particular insecurity they have. So as far as I am concerned, or I think I would actually look at a good quality mutual fund, index fund, along with a term insurance which would cover the amount that my kid will need when they are off to a university in case something happens to me. I would think that is a better proposition than going for a children's plan as such. I hope I have covered all the different aspects of planning for your kids' higher education, and also I feel this video would be useful for many parents who are not in a position to think on how to go about with their children's higher education planning. Thank you so much for your time. Please like, share and subscribe to this channel. Please put in your valuable comments that will motivate us to do more such videos. Thank you.